Look around you. The money in your bank account, the salary you earn, the cost of groceries, and the stock market. Every one of these things is connected. They are connected by a single idea governing the daily lives of billions of people: money. Most of us spend our lives trying to earn it, yet almost nobody asks where it actually gets its value. If you ask around, people usually say governments, banks, or gold. Something real, something tangible. But the foundation underneath modern money doesn't rely on anything physical at all. Less than 60 years ago, a decision made during a single weekend changed the rules of how wealth is measured. That moment severed our currency from physical reality, replacing it with a fragile foundation: trust. For thousands of years, civilizations faced a problem. How do strangers trust that something valuable today will still be valuable tomorrow? Eventually, they settled on gold. It didn't rust, it couldn't be manufactured, and it was difficult to fake. People believed it couldn't be manipulated. By the end of World War II, Europe was devastated, yet the United States emerged stronger. Its factories were running at full capacity, and American vaults held nearly half of all global gold reserves. In 1944, representatives from 44 countries gathered in New Hampshire. They needed to build a stable monetary system to prevent future economic disasters. The result became known as the Bretton Woods system. This chart shows how the structure worked. Every major currency was tied to the US dollar, and the US dollar was tied directly to gold. Specifically, $35 for 1 ounce of gold. Fixed and predictable. The dollar became the anchor of the global economy. By lending America's physical gold stability to the planet, international trade expanded and the post-war boom began. There was a hidden danger in that arrangement. The world needed massive amounts of dollars for international commerce. As America supplied more paper currency, the static gold reserves couldn't keep pace. There were more claims than gold. By the 1960s, heavy spending on the Vietnam War and the space race accelerated the imbalance. Foreign governments began noticing. French President Charles de Gaulle openly questioned whether America could truly honor its promise and suggested that if dollars were equivalent to gold, countries should exchange them. They began doing exactly that. Countries sent dollars and requested gold. Physical metals started pouring out of American vaults, and the world approached a breaking point. By August 1971, the crisis became impossible to ignore. Inside Camp David, President Richard Nixon met with his advisors. The gold reserves continued shrinking, and financial markets grew nervous. The administration faced a stark choice: defend the gold standard and endure severe economic pain, or abandon the arrangement entirely. Neither option looked attractive. On August 15th, Nixon addressed the nation. He announced the United States would suspend the convertibility of dollars into gold. The gold window closed, ending the promise linking money to physical matter. Following the announcement, the world didn't collapse. Banks remained open, businesses continued operating. Life moved on. That fact revealed something profound. Money had never truly been gold. The true foundation was always a collective agreement, trust that society would accept the currency tomorrow. Once money was freed from physical limits, global credit, debt, and financial markets expanded at an astonishing speed. But there was a trade-off. The same flexibility that fueled growth also encouraged borrowing. Entire economies, corporations, and consumers became deeply dependent on continuous debt to survive. This graph shows what happens when unconstrained money creation meets reality. When infinite money chases finite assets, it pushes prices higher. Over time, that dynamic steadily drives up the cost of living. Financial assets expanded dramatically, creating massive wealth. Yet that wealth became increasingly concentrated. Those who owned assets benefited the most, while those relying solely on wages struggled to keep pace. The modern monetary system is incredibly young. Many people alive today were born before 1971. The financial world we consider normal is less than a lifetime old. Human civilization spent millennia using money tied to scarce physical assets. Then, almost overnight, it switched to a system built purely on psychology. This system has generated immense prosperity. But the question remains whether an economic engine built entirely on debt and belief can sustain itself forever. Ultimately, Every financial decision we make today exists inside an untested, ongoing global experiment with an unknown ending. The modern world replaced gold with trust, and belief throughout history has always been one of humanity's most powerful forces and one of its most dangerous. The story didn't end in 1971.